Okay, so uh, as I mentioned, we need interest rates for loan, and also last time I also mentioned that since Libor as a benchmark was killed by the banks which were biasing the pricing on the Libor market, now we don't have this benchmark. So actually each country has its own reference interest rate. So this is the sad reality. So what we can do right now in terms of modeling, at least we can see money market data and how banks are lending to each other. And also we know these are German ones. Come on. True treasury benchmarks. Okay, it's nice, but so this is what we need here. And after that, this is just the benchmark rate. So we were able to see that when SpaceX, which is a nice company, was financing itself through their variable interest rate loan, they had this 4.25% premium above the LIBOR rate. So we will mimic something like this. So first of all, we need data, and in this case, money market data. And luckily, on the money market data, we have longer maturities, not just within a year. Because in the past, in the good old days, money market data was only about a year and nothing more, but now they added additional interest rates. So, okay, we can be successful in terms of reconstructing the database. So, okay, today we are not going to any sensitivity analysis because we did this last time. So, since they are absolutely co-integrated with each other, so what happens in the bond market and what happens in the interbank market, so there should be no deep difference. So let's just add the loan interest rate here. Euro interbank interest rates are there. And now, obviously, if we are talking about taking up a loan from a bank, then we have to go for the ask. Okay, the spread is not that high, but still 3.13. It's so nice that it's flickering. 2.89, 2.82, 2.8, and 2.81. Maybe I'm the sole or last person at the continent who is crying about that good old days are over when high interest rates were present in the market, because now if you are just checking the curve, we can see that they are expecting decreasing interest rates. So while in the short run still the key policy rate of the ECB is present, which is still 3.5. So in the 2-week time frame, we can still see that okay, it's affecting them, but otherwise we can see that now the market expects a decrease towards the targeted inflation's 2%, which is sad if you are not a debtor but a net saver as a household. So this is the sad part. Okay, but we have to add the premium. And as I mentioned, in case of the SpaceX, that was 2.25%, so we can add it. Should we check other companies? Why not? Arianespace. Hopefully this one. Yes. Depth structure. They don't have much depth, so yeah. Sure curve. Nada. Okay, so let's go for the parent company. Oh, we have ultimate parent. So I find the wrong Arianespace. How can you? So probability of default 0.68 or sorry 16%. Everything is in the red. Only leverage. Okay, they don't have that practically because it's 3 million euro or something like this. You have zero profitability, you have zero liquidity, you have zero growth, and A rating. Come on, guys. What is this? Terrible. Okay, so instead of just checking this company, let's look for Airbus. Since it's one of the parent company, this should be a real actor, not just something which is mimicking a company. So in this case, we can see two loans. Hopefully one loan will be revolver line of credit. Yes, amount of money, issue date. And after that, nothing more. Please give me some spreads. Okay, we can see the banks. So this is a syndicated loan, what they were able to get from Bank of China, from Berkeley, from BNP Paribas, and so on. And investment grade, okay. Loan package. Nothing is about interest rate. Okay, so the idea was great, just maybe the other one will be better. No, it's also useless. In this case, the issuer curve will be also meaningless. No, we have data, gentlemen and ladies. Nice. Wow. But these are bonds. Still, if you would like to calibrate or bond yields, we are a bit pessimistic, I think, that they are able to fund their themselves, at least at group level. Okay, Airbus is much more reliable than our Arianespace, which is not doing a thing. But we can see that we are way above this 2.7, 2.8% of yield, what they are presenting here. So Okay. Just for fun, let's see this rating here. And also they are, so Airbus is considered also as simple A rated company, what I can understand. So in this case, I am not sarcastic at all, because in this case I can see that. Okay, this one is reasonable because they are making money and they have products which can be sold on the market. So, okay, so once I realize that we have no data here, then let's go for the interest rate for debt. This plus this one, and also we should divide it by 100 to create percentages. Yep. Okay, maybe more decimals. So this one is more expensive than just using old-fashioned bonds. And also the question is that what will be the collateral? So the collateral behind this loan, we have to offer something, so we have to dig into our assets, long-term assets obviously, so properties, and I have to take up a loan. We can say that, okay, I don't know what are these properties, but if we are just using all these properties as a collateral, the problem is that in this case the value of the collateral will be dependent on that. So they must sell this asset within a year. So this is usually how banks are defining collateral value. So it doesn't matter that what is the value of the property in our books. They are always checking that what is the short-term liquidity, short-term liquidation value. So it means that they are asking from at least two agencies who will determine the value of these properties or this property, and after that they are checking that, okay, usually it's a real estate agency or something like this, they get these offers, and after that they absolutely ignore what is in our books. So hopefully this property will be enough. But now we cannot modify, we cannot sell the property, we cannot do anything with the property without the permission of the bank. So this is a huge setback compared to the bond where we are just issuing it and we just have to pay enough to get a nice rating, and we don't have to do anything more. So this unknown collateral is enough, and in this case I just have to create the report. So bank loan from the SpaceX data, we know that they were funding themselves with LIBOR plus % loan. Therefore, we will do the same with Euro benchmarks from the money market. Euro benchmarks benchmark interest rates, so interbank market interest rates. Yep. So now we can say that okay, this is supposed to be already a percentage. Because it looks ugly if I'm just... I just want to add the graph and ignore the rest of the problems, but... then we can ignore the division. And now everybody is a happy percentage. And now we can add this as a graph. So we can see that the premium, which refers on our partner risk, is flat, but the rest is changing. Just this change is not that dynamic as it should be. Okay, at least it's not zero, so I should not cry about this one, because 2 years ago, 3 years ago, it was nothing. Okay, variable interest rate. Okay, now we have this, and then we have to say that bank loan requires collateral, which will be or be property from our long-term assets. And hopefully the real estate agency and the bank will also say that this is enough as a collateral. If we are funded through venture capital, then in many cases the cash flows which are generated by the company in the future, they can be also accepted as a collateral, but in this case we need venture capital fund as sponsor, which is right now, this is not the case for this funding scenario, so we can skip this. Then, what we need here, let's put it here, let's put it there. Then, we have to collect the usual stuff. So, valuation, and probability of default, but to do so I have to update my bond yields, and before I'm wrecking my whole Excel sheet, then I will create another save file. So instead of this will be loan. Okay, and now we can say that we already had some data. Okay, so now you can see the difference. So this is from spring, when I created the data set, and at that time it was not 7 point something, it was close to 8 point something. So this is what happens when central banks are starting to cut their policy rates, and the long-term interest rates are also decreasing. So poor thing is now disappearing. Okay, and now we can just say that paid interest will be determined by this rate here, which is smaller than the catastrophic scenario here. And now we just have to see that, okay, in terms of valuation, where we are. Shouldn't we have a table or something for comparison? Ah, there is. Okay, so last time we had so loan and then probability of default. This should be also updated, or it's already updated because it just recalculated the values. So now we can compare them. It would be so nice to see. So in case of bond, these two things should be combined as a, it should be much more like a range, that the worst case scenario is this and the current state is that one, and of course it would go up upwards if it's we are going back to zero interest rate environment, which hopefully we are not going there, but okay, that would require way too much work, so right now we just let's use a red color to highlight that value is better than the worst case scenario, but come on guys, it's disgusting. Okay, and if we are doing the probability of default, or okay, this is going in the opposite direction. No, you are not going there. Then this way. Yes, now it doesn't have any impact on the probability of default. Okay, for the loan this is a bit smaller, but I know that I'm mentioning it way too many times, that so you can't make a company profitable with just cutting interest rates. So I understand that from macroeconomic point of view, this is the job for a central bank. From micro, from corporate level, first we have to use our assets right in the proper way before we are just saying that okay, now the interest rate cuts have an impact. Doesn't. So this is the worst case scenario where interest rates are in the sky, and this is when interest rates are low. So who cares? Although that the narrative should be different because I'm teaching this topic just. In this case, we cannot create value by just adjusting interest rates as a central bank. If the assets are useless within the companies, or they don't have markets, or their products are useless. So in terms of valuation, funding through loan, restricts this is the company from the significant modification of the property. So the collateral, which can hinder our plans to modernize our asset, so or change the asset, or yeah, to achieve the usability of the first stage. So maybe we have to cut half of the launch tower down, or maybe we have to put some concrete here and there. Maybe it will be much more risky to use the launch tower because early versions of the rocket will explode, obviously, during the launch procedure or during testing procedure. So we will be already riskier than before in the first 2 years until we are ramping up our operations. So in this case, having a really anxious bank in our back, maybe that's the best scenario. So at the same time, and in terms of valuation, yeah, I already used this one. So bank loan did not provide any benefits for the company compared to the bond. Compared to the flexibility of bond issuance, sorry, or bond funding. And also, the probability of default, oh come on, this should be scaled on 0 to 1, we don't have further probabilities. And as we can see, higher interest rates do not contribute to higher probability of default if the company is otherwise profitable otherwise. I mean, we are already consolidated the company, so yeah, okay, enough ranting. So, next thing, share issuance. So, that's the tricky part. So, we have to increase the number of shares within the company. So, first of all, let's go back to saving as. No, this one. Save, then save as. So this will be share issuance. Come on. So right now I don't need debt. So we are zeroing out the debt. Dun, 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 dun. Buy these. Okay. Should we say that, okay, the rest of the debt still will be funded through bank loan? Whatever, we can do it. So we are talking about 3 million. We are spending more money on fuel, so.
Professor, I just have some question. Like,
yeah.
If you go back to that.
Yes.
Yeah. So in here, like, you just delete 2 point something, right?
Yeah, it was referring on this.
Yeah. So like, do we need to reflect this in the report too? That because we previously put that table in the table and we write like we have that amount of that. So we need to go back and change the numbers again.
This scenario, yes, but I will use this number just not here at the debt, but I will increase the common equity. So I'll just say that okay, now common equity must be increased. So we are selling a lot of shares for this 503.
So we don't need to change then previously this.
No. Right now this is a new thing. So already what you have done, it's good. So we are issuing shares. Now I can roll it through. And in this case, the good news is that do I pay any dividend? Nothing. We are collecting it just within our cash reserve, so it's okay. Let's check that. Do I pay any interest? Bless you. Yeah, we are paying something, but it's not high. Financial revenues, they are increasing because of our cash reserve. They are so huge. And we don't have any further things because, okay, I can check that. But cash reserve, it was already modified. So, okay, so how can I sell such amount of shares within the company? Okay, and now we can ask the question that, yeah, I had to do this. And in this case, let's go back to the proper no recovery scenario. Because right now, if we are going to anyone, the number of shares originally in the case study it was 1 million shares for this price. So it's always the question that if I would like to issue a new share, then the price of the new shares will be related to this price here, or so for this 4.7 thousand euros, or since they have a trust in our beautiful business plan, so we can sell the shares immediately for this price, which is a different thing. So in this case, it will define also the number of shares within the company. So let's not overcomplicate things. Let's say that investors will buy only the additional shares for the original market price, and they don't ask for any further bonuses, and after that we can see. Yeah, it's already there. Oh, it's not there. Okay, so let's copy it. Value for the company. Okay, this is already a bit different, so let's update my numbers here. And value of the shares. This is already a bit different. Okay, so now I just have to see that how many shares should I collect. A lot of money. So this amount of money which is necessary for my survival. So for those groups who have a funding need of 20 million euros, this is not a significant question. For me, yes, it is. Okay, so share price today. This is coming from valuation, old valuation, and this thing. It's good because 1 million was the number of shares, so in this case we don't have to do anything. So this is euros. So now we just have to say that number of new shares. Okay, so this number multiplied by 1 million to avoid any displacement, and oops, no, that's it. Is it enough? Is it enough? Yes, it's enough because here we are losing one. It doesn't matter. Okay, so this is the amount of shares what we should sell on the market right now to collect the funds. But we have to bring it back to the valuation, so number of shares, this thing, plus this one. And I will delete these values because this is so terrible. We are not using them, just keeping the space. So we can say that, okay, one share value with VC investor, no debt. So in this case, we can assume that, and also I have to update the VC share because this is not good right now. So we can assume that we can sell the shares on the stock market, but the company is private, and I don't think that what would happen here during an IPO, that the share prices would drop immediately. So until we are producing some kind of a value, so and it also fits better to the case study that, okay, we as a venture capital fund, so we were preparing this project for the company, so we have this business plan where we are defining the new product line. We were defining the new generation of the profit, the new generation of the expenditures, and all the rest of the things. And obviously, we are not just sitting here and waiting to be implemented, but also we are buying the shares. But in this case, we have to buy this divided by this one. 11%. So it's cool. So our potential profit, so if the share prices are increasing this level around the exit or after 5 years, then we can have a profit ratio of this minus that one multiplied by the number of shares, this, and okay, that one is, this seems to be realistic. So So this is the added value of the whole project here. Obviously, at the beginning, so if you are just checking that, okay, but the initial investment or funding need was this money, so this money divided by that one. Yep, sorry, this one is million, so we have to divide it. And on 6. So we have just this 50% of profitability. Which is still a reasonable percentage, so okay, I can live with that. So doubling the money after 5 years, it's not a bad project for us. Even if we know that we should calculate the present value of this, so still we could say that to make this nice, then okay, let's put everything into a bracket and divide it by 1 plus, let's find a nice interest rate. We have this interest on savings. Okay, this is unreasonably high. So not this one. So let's go for the sovereign premium and the inflation altogether. But this will be 0. On the 5th. Okay, so still after the calculation of the present value, because of 0 interest rates in the government bond market, then okay, maybe I will add additional something. So let's add also risk premium, and because we are a risk taker, so why this thing is even increasing? It should decrease. Okay. In the opposite direction. Okay, so now it's good. So it's 33% profit, not 67. Come on. Say a double-digit profit, so we can live with that. So now we just have to define all the things here. So we need equity invest 3 million euros in equity investment. So venture capital firm will acquire 80% package in the company after buying the new shares for we are absolutely conservative in this term. Let me close this one. So usually, if venture capital firms are buying shares, then already some growth premium will be recognized in this one. But right now we don't do this. So yeah, let's say 2. At the original value. So this one is much more like a sneaky attack, so we can say that without publishing anything, we are just buying the shares after the issuance, then firing everybody from the management because they are useless, and then we are just starting to implement and hope that it will happen. So okay, at the original value, then in case of valuation, so which one is the more expensive? Funding through equity or funding through debt? So right now debt is artificially expensive. But if you are going back to the good old ages, so yeah, it was 24.17. Okay, and also this one is 26.27. So 26.27. This one. 19.20. So even if we are doing this, we can say that equity is still cheaper than debt. So even Modigliani and Miller would say that we have to finance the company through the cheapest option, and right now the cheapest option is equity. So it's okay. But also at the same time, since I went back to the from the disaster scenario in terms of interest rates to the more realistic current interest rates, it means that now our cash reserves are growing in a less dramatic manner. So it means that the value of the equity decreases just because of this, because of no artificially high interest rates. So our poor profit dropped to 17%. Oh, this is sad. Anyway, we should see that. Okay. So, share price. So after the implementation of our business strategy, our share price will increase to this amount of euros, which is nice, but still this is fundamental valuation. So if it would be publicly listed, it can be anywhere around this. So this should be maybe, under optimum circumstances, this should be the mean or the average of the share price. But if this is a private company where we don't have share price, then trade offer should be made around this value. So in this case, this is not an unrealistic scenario. So our share price will increase to this, meaning that our investment has the potential of creating 17% profit. Yeah. So that's why we are not so motivated to put any growth potential into the valuation. So we don't want to buy the newly issued shares for higher than this money, because at the end of the day it will just ruin our profit margin or profitability at the end of this endeavor. So we are motivated in just push it back and not to deal with any of this. I can delete this one because this number is unused. Also, we cannot be motivated to reduce the number of shares during this procedure, to say that, okay, the share price should be bigger because it has the same influence. So at the end of the day, this funding runway requirement is limiting our degree of freedom. So if we cannot cut this one to increase the number of new shares, okay, so what happens if you are undercutting? So if you are saying that, okay, right now the fundamental value is this, but if you are not doing anything, you will be disappearing from the market anyway. So if you are hanging downwards, so not going upwards during a listed, but saying that, okay, we know this, but we are just buying it at a discount of 10%. So what would happen? So 0.9, just for fun, yeah, and not point, sorry, single comma. So in this case, they have to issue more shares. In this case, our profit will increase nicely. So it's really funny that, okay, number of shares are increasing, which means that at the end of the day, share price will be lower, but since we have a bigger slice of the cake, then this will be still good enough for us. So let's check both scenarios. So we can also say, or if we have the chance, to have a discount. Of 10% during the share purchase. As the original owners are not convinced about the future of the enterprise, SpaceX will eat them terribly. Then we have the chance to acquire shares, sorry, to buy the new shares for this amount of money. Still, let's say that okay is 4. Which will increase. Increase. So let's see the valuation. Okay, so share price must be going down a bit. Yes, because there is more shares on the market, so which will decrease share price. The potential euros. At the end of the day, this is not much. Let's create just so we are losing 130 euros per share in terms of fair or fundamental value, but potential profit rate will increase to 24%, which is nicer because obviously a venture capital firm must to show a good track record. So our future investors, when we can show them that we were not generating, or instead of generating 17% of profit, we were able to generate 24% of profit. Obviously, they will more happy to invest in our next venture capital fund in the future after we did this and closed down the previous fund. So, and also we can see that our share increased from 11 to 12%, which is quick question that what can we do with the 12% of voting power within a board? Because unfortunately, usually not much. So venture capital firms traditionally, according to the literature and data, they have this 30-50% of package to have real strategic influence. So right now we are underappreciated or quite poor in terms of our voting power, but okay, I don't want to overcomplicate everything because we can see that this is what numbers are allowing us to do. So then let's see the table. So first of all, we have to put so this is the equity issuance with this discount, and also let's add the probability of default. Wow, we can see significant difference. Yeah, obviously if you don't have that, then it can be better. Equity, in this case no discount. So I have to turn everything back. There you are. I will create a discount. New share. So in this case we can see that it's much more transparent than just hiding it in the codes that you have the this is price, and this is probability of default. And also, just for fun, let's add the original scenarios. So this is the, sorry, this one is the useless share price. So, original, probability of default. And now I have all the stuff here, so at the end of the day, when you have to present at the end of the semester, these two things will be crucial during your presentation. So that's why. Let's start with the value. Okay, we don't care about the loan anymore, so let's give a gray color. Oh, sorry. The filling must be, because this is boring, we don't care about this. Original, let's give red. So this is the warning sign that we don't have to be here. So we can see that there is no such a worst case scenario for our funding circumstances where we can go near the original value. So even if interest rates are really high, still we have, I can double it, but at least it's more than half bigger. So okay, let's have let's use nice orange colors because it's calming in nature, and we can see that both of them are nice. So we can see the value, and after that we can add also the probability of default, which is still under terrible scale, so I just have to modify it to this. And also these are percentages, so let's use them as percentages. Okay, so that one is the red. This one is the yellow. and I think they are overlapping, yes, with the other one. So just add. And after that we don't care about the remaining coloring, or maybe, okay, let's give it this one, the gray color, but after that I don't want to color any further because we can see that, yeah, which one is the best. So as we can see, funding through equity issuance will provide the highest growth evaluation, since the value of equity, cost of equity is half. Can I say that it's half of the debt? We can say that it's half of the debt, so okay. It doesn't matter, we are talking about bonds, we are talking about loans, and the useless original state. This one is nice. Similarly, this approach and it's less risky. So if you are just checking the first business year, the second business year, so it's always lower than the rest of the scenarios. So has the lowest risk. Obviously there is no interest rate risk within it, so it's not that surprising fact that we have this one. And it provides us for VC firm the highest potential return. So right now we could say that if we would stop here, then we were able to find more niche to fund the company.